Okay, hi everyone. This is going to be the second lecture for chapter 18. Going to break this into three series just because it gets complicated with all the numbers. I would lose you if I got you for too long on a single video. So, to kind of recap where we were and where we're going, right, we talked about dividends, right, and we said that generally, depending on the framework, right, you're going to have a dividend if it's from E&P, right? If it's positive, positive, basically you draw from there. Thereafter, any excess distribution reduces your basis, and then anything beyond that is going to be a capital gain. In that framework, right, we talked about going from taxable income to CEP, right? You have to make adjustments. We said there's a relationship and kind of a roll forward between CEP and AEP from year to year, right? We talked about the way and the adjustments you make to get from taxable income to E&P. Then we said, okay, once you establish your CEP, right, and you know your AEP because it's basically just a roll forward. And hey, for being an academic example, they're going to give you these numbers if they test it this way. There's four scenarios, right? Like positive, 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 negative, negative, positive, negative, negative, right? We looked at those from kind of a simple way where it was one shareholder. And then we looked at it where it was a little bit more complicated with multiple shareholders. And generally, right, when we were looking at it, it was just a simple cash distribution. Okay. We talked about each of the roles, right? 1, 2, 3, 4. We looked at some examples there. Now, right, we're going to build off that framework, right? And instead of the corporation giving pure cash, right, they're going to give non-cash property. So a machine, equipment, right, to the shareholder in a non-liquidating distribution. Right, so this gets messy, right? It's a little bit more complicated, right? Whenever you have property, right, something other than cash. The reason for this is there could be a liability attached to that property. And then, as I have here, the difference between the fair market value of the property and the tax basis of the property is going to affect the calculation of E&P. In other words, it's going to cause a gain there. We will see that they treat it, the corporation, as a deemed sale of that property. So that's the setup. We're looking at non-cash distributions. Let's go to this slide first, because this is a good summary slide, right? Like up until here, like they build out each of these items, but let me explain it from here, right? So you got the corporation, you got the shareholder. First off, when they push out the non-cash property, tax law says, hey, Mr. Corporation, we treat that as a deemed sale of the property, namely the amount realized minus the adjusted basis, right? That will give you your realized gain or loss, right? And then we said, with that, a couple things, right? So that's realized gain or loss. Let's back up here. In this framework, right, the amount realized, and we'll talk about this, is going to be the greater of the fair market value of that machine or any liability on that machine that the shareholder assumes, right? Maybe we owe $500 on that machine and the shareholder's like, look, I'll take it on. So you basically, for purposes of this disposition event, amount realized is the greater of those two, the fair market value of the machine or the liability the shareholder assumes. Okay, we can put a little check mark there. In this way, right, there is a realized gain. However, you only recognize gains, right? And the idea with this is, in other words, you ignore any realized losses. So for taxable income, right, you're going to use your tax basis there, amount realized minus adjusted basis, only recognize gains, ignore losses. For CE&P, purposes. You're also going to run the numbers on that. Instead of using your tax basis, you will use your E&P basis. What's the difference between those? Well, most of the time it's going to be the same. If it's tested on the exam, it's going to be the same. But if you're wondering, like, why is there different bases? Well, hey, remember for tax, we use makers. And for E&P, we use a different recovery system, ADS. So, right, if it's your cost minus your accumulated depreciation gives you your basis, you're going to have different bases potentially if you're depreciating it under different like rates or schedules. In any event, right, when you have this gain, right, you calculate it, it increases your taxable income only for the gains. Likewise, that gain will also increase your CEP, right? For there, because your CEP is essentially your taxable income with adjustments. So hey, it hit your taxable income. That's going to hit your CEP as well. And then once you adjust your CEP for the gain, right? Then what you're going to do is, as a general rule, and the book isn't like super particular here in the sense that if you look at the tax code, it's like more specific and there's nuances to it. But generally, once you adjust the CEP for the gain, then what you're going to do is reduce AEP by the fair market value and increase it by any liability the shareholder assumes. In other words, we then have to kind of think about what are the effects, right? We talked about the gains, but what are the effects on the corporation for E&P, right? This will make more sense when we come to it. I'm just giving you a high level here. From the shareholder's point of view, right? We looked at this before with cash, right? We said, oh, okay, we have cash. We're going to look at the 4 scenarios, plus, minus. That kind of tells us what to do. Right? And the cash was a number amount, right? You got $100, you got this, you got that. Accordingly, what we need to do, right, is take this property and give it a number, right? Normally what we're going to do here is, right, it's going to be the fair market value minus any liability the shareholder assumes. So if there's no liability in play, it's just the fair market value is the number we get it. Right? Once we get that number, right, then we just go and apply the E&P ordering rules to tell us, hey, what's the dividend? Hey, what's a return on capital? Hey, what is a capital gain in this way? And then finally, right, afterwards, as a general rule, right, if we went up to the shareholder and we said, oh, okay, you have this machine, can you please tell us your basis in this machine? As a general rule, it's just going to be the fair market value. In other words, we ignore the liability. So there's a lot of twists and turns there, right? This is why I wanted to do it as its own lecture, as it were. So let's check out and kind of examine this one by one, right? So it says the measurement or amount of the distribution, right? So we're looking at the shareholder here, right? We're trying to put a number on this. It's generally going to equal the cash they get, right? If there's cash, plus the fair market value of the property, right, minus any liabilities they assume, right? So that's this guy right here. Generally, fair market value of what they got minus the liabilities of what they assume. Their basis in the machine, right, it's going to be the fair market value. In other words, we ignore any liability that's assumed, right? So that's this guy down here. Let's look at 18.8, 18.9. Nope, of course it disappeared on me. All right, we have a corporation. They distribute cash and a bike to a shareholder. Looks like they have CEP of 100,000 and no AEP, right? So CEP 100, AEP 0. What is the treatment for the shareholder, right? Well, we got to put a number on this, right? So the number is going to be, right, the fair market value of the cash plus the fair market value of the bike, right? Cash plus property fair market value. Accordingly, right, our number is 16,000, right? That's like we got 16 in cash. Oh, we have 100 of CEP, right? All of that is going to be a dividend because it came from AEP. Likewise, if we went up to this shareholder afterwards and we said, what is your basis in that bike, right? It's going to be the fair market value. All right. Let's look here at 18.9. We're going to add a little bit of a variable to this. We have a corporation. They distribute land, right? So I'm just going to put some things on there. Has a fair market value of 60, $12,000 liability on it, right? The shareholder's like, look, I'll take on that liability, not a big deal. The corporation has CEP of 100, AEP of 0. What are the effects for the shareholder? Okay, so we got some stuff here. We got to put a number on it, right? In this case, right, we said it's cash plus property fair market value minus liability we assumed. So here, right, it's going to be, we didn't get any cash, but we did get property of 60 and minus the liability we assumed of 12. Hey, our number is 48. Oh, right, we have enough, right? It's, basically positive, sort of neutral. We have enough. All of that's going to be a dividend. I come up to you afterwards and I say, hey, Mr. Shareholder, what is your basis in that land? It's going to be the fair market value. We ignore the liability as a general rule for the basis. Okay, next, right? It says the distribution of non-cash property can affect taxable income and CEP, right? Why is that the case? Because, hey, the corporation treats it, when they push that out, as a deemed sale, right? That's what this guy is saying. It says here the taxable income is affected because gains but not losses, right? You only get gains, not losses. Gains, not losses, are going to be recognized from that sale. And that gain, right, is going to increase CE and P, right? We're going to just assume that the gain, whatever the gain was for tax, we're going to assume it was the same for CE and P. We said it potentially could be different because we're tracking bases under different systems. But let's look at 1810 here. We have a corporation. They distribute to a shareholder. Looks like a bike. Has a fair market value of 1,000. Has both a tax basis and E&P basis of 650. Right, so fair market value of 1,000, basis of 650. What are the effects for the corporation? Right now we're looking on the left side, right? We're not looking at the shareholder. Well, they treat it as a deemed sale, right? It's going to be amount realized minus adjusted basis, right? Gives you your realized gain or loss, of which we said you recognize gains, but you ignore losses. So here, right, you're on the numbers. It's 350. Hey, that's a gain. That's going to increase CEP. Down here, they change the facts where you have a loss, right? Well, if you have a loss, you're not allowed to recognize that, right? And then it says, oh, okay, well, if you have a loss, maybe you'd be better off selling it, right? You can read it down there. That would let you maybe utilize the loss. Then we said, right, okay, when they push it out, the corporation, we know that it is a deemed sale, right? Amount realized minus adjusted basis. But we said the amount realized is going to be the greater of the fair market value, or in this case, if we go back over here, right, the liability the shareholder assumed, right? So that's what this guy is saying right here. So let's look at 1811. Oh, flying off the screen. All right, they're giving us a setup here. It looks like there's land and a mortgage, right? Tax base is 20. What are the effects for the corporation? What are the effects for the corporation? Right, so we know that they push out this land. It's amount realized minus adjusted basis. Realized gain or loss, you don't get the losses. The amount realized is the greater of, right, fair market value, in this case 60, or the liability the shareholder assumed, 12, right? What's the winner there? Right, well, fair market value, 60 is bigger than 12, we'll use that. In distinction, right, down here, whenever we have amount realized minus adjusted basis, gives us gain or loss, right? We have fair market value and liability the shareholder assumed. Well, it's 60 versus 75, right? The liability assumed is bigger. So we're going to use that guy there for it. Right, so there's the summary, right? We've looked at it. You can like rewind the video to watch it sort of slower if you want to redo that here. Kind of continuing from that, right? So this is like sort of the intersection here. We're now going to go down here, right? We said gains from that sale are going to increase CEP, right? So that's what it's saying here. As discussed, the distribution of appreciated property results in a taxable gain. If the tax basis is the same as the E&P, then the gain is the same for taxable and income and E&P. You can assume, right, this will be the case on the exam. However, do be aware, right, that there can be a difference in the E&P basis in the tax basis, right? In that case, right, you're going to need to make an adjustment, right? And we said, regardless, right, you're not going to be able to deduct any losses for tax or E&P. But you can look at 1812 there to kind of see that, right, how that shakes out. How about the effects on AEP, right? So if we go back here, right, we said, okay, you have to increase your CEP for the gain. Then you reduce, as a general rule, the AEP by the fair market value of the property distributed and increase it by the shareholder liability assumed, right? So that's what this is saying. The general rule is, right, if you distributed appreciated property, you're going to reduce AEP by the fair market value. You could, right, there's the exception of depreciated. You can look at that. And then if it's subject to a liability, right, you are going to increase AEP by the liability the shareholder assumed. One thing to be aware of here, right, any downward adjustments, right, when you're reducing AEP, right, because this is really from the distribution of the property, it can't make AEP go negative, right? Remember, the only thing that E&P can become negative from is kind of naturally becoming negative from like an NOL, not from distributions. So let's look here. Right, this was the one I said you can look at it where the CEP is different from the taxable income because of like bases difference. Just look at it quickly. I'm not testing it, but if you're like a tax geek and you want to see it, let's check out here, right? So this is a good kind of where it comes together, right? Corporation distributes land with a fair market value of 60 and a mortgage of 12. Has both a tax basis and E&P basis of 20. CEP of 100, which includes a 31,600 gain from the distribution of the land, right? So let's go over here and kind of see that here. So it has a net gain of 31,600 distribution from the land. So one of the things they factor in that comes into play with E&P is tax liabilities. That's beyond the scope of this. But let's say what's going on here, right? We're looking at the corporation. They pushed out land to the shareholder, right? They ran the amount realized minus adjusted basis formula, right? And let's say that was, they're telling us here 31.6. That 31.6, right? Once we get that, right, we're going to kind of add that to our CEP, right? Because that's like an income item from a gain, right? After we add that to our CEP, right, we're looking at 100,000, right? That's what this guy is saying right here. Our CEP is 100,000, which includes the gain from that sale. Our AEP is 500 at the beginning of the year. So let's see here what's going on, right? They want to know what is the accumulated E&P at the end of the year as a result of this distribution, right? So we have appreciated property that we distributed, right? There was a gain on it. So the rules tell us, it's going to be the general rule, you're going to reduce AE&P. Well, there's kind of an implicit thing here first, right? Like step 0, increase CEP for gain, right, from AR minus AB. Once you do that, right, then the next step is reduce AEP by the fair market value of the property, right? So here's our beginning, right? We're going to add our CEP, which includes that gain, back out the fair market value of the land, add the liability the shareholder assumed. Hey, our end of year AEP is going to be 552. Similar framework down there, right? You can see the exception over here. Not as concerned with the exception. I want you to just understand the framework here, right? So if we go back to our little cheat sheet, right, we said AR minus AB is a gain. They only recognize the gain, not the losses. That gain increases taxable income. That gain increases CEP. We're going to assume it's the same for both of them, right? We said once you factor that gain in, right, to CEP, you then have to look at the effects at AEP, right? You're going to reduce it by the fair market value of that machine you pushed out, and then increase it by any liabilities the shareholder assumed, okay? So with that, right, let me see, do I want to talk about stock distributions? All right, maybe I'll just quickly talk about these and then I'll save the last 10 slides for a separate lecture. So it says, instead of distributing cash, right? So far we've looked at a corporation, right, that pushes out money, right, to the shareholder. One of the things they can do is push out additional shares of stock, right? So for example, a 5% stock distribution increases the number of shares by 5%, right? So if you owned 100 shares and they're like, look, we're going to have a 5% stock distribution, you're going to get 5, and then afterwards you'll own 105. You got to compare that with, right, a stock split, right, in which the number of shares outstanding is increased by the ratio of the split. So for example, if it was 2-to-1 stock split, right, what's going on here, right? Well, you owned 100, and for every one you owned, you get 2, right? Afterwards, you're going to own 200, right? So 5% stock distribution, you own 105. 2-to-1 stock split, you own 200. Difference there in the math for how you got that. Now it says, in theory, stock splits and pro rata stock distribution do not provide a shareholder with any increase in value, right? Because before and after the declaration, the shareholder would have the same effective ownership percentage, right? And it's basically saying something like this, right? Hey, you got double the amount of shares, right? Before, maybe you owned 10%, right? And now you got double. That's great. You have more shares, but everybody else who's a shareholder got double too, right? They got two, they got two. So when you look at effectively afterwards, if you own 10% beforehand and you got double, and everybody else had their relative ownership percentage and they got double, well, afterwards, you own 10%. You're not really any better off. You just have more shares that are each worth hypothetically less. Right, so that's what's going on there. Now, one of the things it says here is in a non-taxable stock distribution, each shareholder allocates a portion of their tax basis from their original stock upon which the distribution was based to their new stock basis, which is going to be based on the relative fair market value of the stock. In the case of a simple distribution, the new per share basis is the original tax basis divided by the total number of shares held, including the new shares. Mouthful, a lot of words. What does this mean? Let's look at with some numbers. Simple example, right? A shareholder owns 100 shares stock with a tax basis of $3,000. Corporation declares 100% stock distribution, right? So you're now going to go from 100, you get 100 more, you own 200, and you retain your $3,000 stock basis, right? Because that's what you paid for the underlying thing that you have. Essentially, what's going on here, right? And we've sort of mentioned this, right? The tax basis per share is what changes, right? Before, right, if you had 100 shares for $3,000, each share cost you $30. Afterwards, now you have 200 shares that cost you $3,000, right? You just have double the shares, but at half the tax basis, right? Your effective ownership is the same as prior. It's what your tax basis is what's changing there. And then it says, note the holding period of the new stock, right? The additional 100 shares you got is going to include the holding period of the old stock. So it's not like you kind of have to start anew there, right? Let's look here at 1814. So shareholder owns 75 shares of a corporation. They have a tax basis of 24. Shareholder 2 owns 25. They got a tax basis of 10. 100% stock distribution, right? So if you owned 75, there's 100%, you get 75 more, right? The combo of those two, you now own 150. In this way, right, the distribution is going to be non-taxable, right? You getting those additional shares because it was made on a pro rata basis. In other words, right, it was really just based on your underlying ownership percentage there. Everybody got their ownership percentage. They're really in the same relative ownership percentage afterwards. Effective ownership hasn't changed, right? Before you own 75% and after you own 75%, right? So it says non-taxable, same effective ownership before and after. The only thing that changes when we have this non-taxable stock distribution is your per share basis. Before you had 75 shares, $24,000 total. Now, right, you have 150 shares, 24,000. Your per share basis is what changed there, right? It's just like that example we saw in the power plant. And then it says non-pro rata stock distributions are taxable stock distributions and generally included in shareholder income. And as such, right, they're going to be characterized as dividends to the extent of E&P, right? So for example, Corporation gives the shareholder the choice between cash or additional stock, right? If you select the stock, you'll have taxable dividends equal to their fair market value. The tax basis will be the fair market value. Let's look at 1815 here. All right, a corporation declares a 10% stock distribution, but offers either more stock or $100 per share in cash, right? One of the shareholders elects to receive 15 shares of stock worth $1,600. Is this taxable? Well, yeah, it's non-pro rata. In other words, they're giving you the choice here. What's really going on? Afterwards, there's a potential where the proportionate ownership is not the same, right? If we compare what you owned before and after, right? If it's the same effective ownership before and after, then it's non-taxable, right? We didn't really change anything. The only thing that changes is your basis per share. If it does have the potential or it is different before and after, then it becomes taxable as a dividend. Okay, so with that, I'm going to pause there. And then the last, 10 or so slides, I'll give in sort of a short lecture at the end.